I'm Rob Henderson with some preliminary views on the upcoming 14 May budget. What we'll be doing today is going through some key questions that clients have been asking us about the upcoming budget. So this preview will address those questions. Look, one of the key reasons which the government's identified is that there's been a $12 billion shortfall on the revenue side of the budget. Now that in turn reflects a weaker economy than they expected in the last budget in 2012. If you look at the numbers, the Treasury is forecasting 5% for nominal GDP. At the moment we think it'll be more like 2.25%. But one thing I'll say is that the expenditure side of the budget is also a problem. If you look back to 2007, you'll find that spending in the economy by the government amounted to about 23% of GDP. Today, even though it's come down from its peak, it's still 25% of GDP. That represents about a $30 billion increase in government spending year after year above the long run average. So I'd say it's both a spending side and a revenue side problem that the government has here. Well, the answer to that question is actually no, because the government, I think, at the moment is doing the right thing by not implementing a discretionary tightening in fiscal policy to get the budget back to surplus. The reason I say that is because we think the economy is already soft. If the government tightens fiscal policy further, that would soften the economy even more. Now, if they do nothing, so they just actually let the automatic stabilisers work, what that will mean is that the economy should continue to grow, although we do think that for the next while it's more like a 2.5% economy rather than the trend growth, which is around 3%. Well, the drivers of the Australian dollar are commodity prices, which certainly have come off their peaks but remain historically strong. Interest rates from the Reserve Bank are much higher than for most other developed economies. That reflects a relatively strong economy, even though it's a little soft compared to many Western economies. Our economy is quite strong. And the third thing is the appetite for risk that international investors have about Australia. Now, we think that international investors really like Australia in terms of a low-risk destination for investment funds. That's also one of the reasons why our currency is high. Now that, of course, is actually a very positive judgment on Australia. If both sides of politics persist in running fairly conservative policy, trying to get the budget back to surplus, that actually will maintain our credit rating, but a corollary of that is probably that the Australian dollar won't fall dramatically over the years ahead. Look, on interest rates, we've been saying all year that the Reserve Bank would need to cut interest rates further as the year progresses. We've thought that a rate cut would come in the middle of the year. The market's becoming more convinced that will happen. At the moment, if the government continues with its current fiscal strategy, the coalition, if it were elected, is set to pursue a similar strategy. That should mean that government policy won't influence interest rates much ahead. On the other hand, if the government tightened excessively, then the Reserve Bank would need to do more in order to try and keep the economy growing. All up, it's going to be a fascinating budget, and we're looking forward to hearing the opposition plans for fiscal policy ahead too. Rob Henderson signing off for NAB Market Economics.